Hi guys, welcome to the MCQs of CA Inter Financial Management. We are doing a chapter called as leverage. Leverage means risk. There are many types of risks that a businessman will face. We try to divide all those risks into two parts. We all have risk that arises due to business operations. But then do remember, any risk arises because there is a commitment of fixed cost. So therefore, whenever you run your business, you try to purchase, you try to sell, do remember there are certain amount of fixed costs that you are incurring. These fixed costs are popularly called as operating fixed cost. Examples of them could be, say, the fixed salaries, it could be, say, the fixed rentals, blah, 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 blah. But then there are some other fixed costs also that comes because of a certain capital structure. Now, these could be in form of, say, interest or in form of, say, preference dividend. Okay, the risk that arises due to these fixed costs is going to be called as financial leverage. And once we try to measure both of them together is going to be called as operating leverage or operating risks. This chapter was all about trying to numerically measure the risk. Risk is always a subjective thing, but then leverage chapter was formed. So therefore, we all could measure the risk. We all could try to be thinking that this is a risky company. This is not. Okay. But whenever you're going to be doing that, you require some kind of a quantification. That quantification comes because of a chapter like leverage. That's what we're about to be doing. Just before I start, for CA intercosting, on every Saturday, Sunday, we are coming out with the regular lectures, which will cover in depth everything that you all require to be knowing. In case you're going to be only doing that much, be sure that you will be getting 90 plus in your examinations, because we cover every question of the module for sure. We give a dedicated kind of a homework section. We hold tests at the end of each and every chapter. There is a summary for every question. There's a ranking for every question. Okay. And all these at absolutely no cost. You get the soft copy of the book also completely free. Let's do the question for today. If DOL means degree of operating leverage, is 1.24, and DFL is degree of financial leverage, is 1.99, then DCL means degree of combined leverage, would be. Okay, bring me the four options, please. You have 2.14, 2.18, 2.31, and lastly 2.47. So just a small summary over here is something like this. In case you all know the answer, please do the comment below for the correct answer. So let's start it off. Now, first of all, combined leverage is to measure the overall risk of a business. Okay. The overall risk arises due to fixed cost, and all the fixed costs are there in two parts. You all have your operating leverage and you all have your financial leverage. As I've already explained, operating leverage arises due to presence of operating fixed costs, your salaries, rentals, up and so on. Your financial leverage arises due to your financial fixed commitments like, say, interest and preference dividend. Any fixed cost gives rise to risk, because whether you earn or not, still you have to be paying such kind of costs. Okay. So overall, there is one formula of combined leverage that is universally true, and that is nothing but percentage change in EPS divided by percentage change in sales. Originally, how I've explained to you all in class, it's percentage change in dependent variable divided by percentage change in independent variable. Sales is independent, and obviously from sales to EPS depends upon so many things. So therefore, EPS automatically becomes a dependent variable. So therefore, combined leverage is percentage change in EPS divided by percentage change in sales. Now, this formula can be converted into many ways. Okay, but one of the things that I require here is that combined leverage is also multiplication of two types of leverages, operating leverage and financial leverage. I guess now the question is very simple to be solving. Why? Because your operating leverage in this question is 1.24. Your financial leverage in this question is 1.99. Please multiply both of them. And here you all have your combined leverage. So combined leverage will be 2.47. And I guess that is nothing but option number D over here. So as per me, option number D should be the correct answer. That is the correct answer. That's it from my side. I'll see you all next time with another question. Till then, take care of yourself. Bye.